Hello and welcome to Invest Her. You're here with us, She the People, on our new series, Invest Her, in partnership with BSE Investors Protection Fund, where we talk about personal finances and helping women build confidence about financial conversations. Today we have with us Kiran Telang, who is a certified financial planner and is registered as an investment advisor with SEBI. In her career, Kiran has worked with clients in both India and abroad, helping them make smart financial decisions, achieving their financial goals, and basically simplifying their financial lives. Today, she's going to take us through what every woman should know about liquidity. Thank you so much for joining us today, Kiran. To start off this conversation, we would like to know from you what is liquidity and how does it work?
Uh, Thank you, Yamini, for having me over for this session. It's an interesting topic indeed. When we talk of liquidity, it actually sounds like jargon. But if we simply understand, I mean, from a common perspective, when we are thirsty, water is the only thing that will actually quench that thirst. We've been used to that. So when you are thirsty, you need water. Likewise, in personal finance, when you need money, you should have money. So that is the essence of liquidity. So when you need your funds, you should have liquidity. So there are two aspects to it. One, having the funds when the need arises, and second, the ease with which your assets or your investments that you're holding, how easily can they be converted into cash. So that is the criteria for liquidity. Say there could be several things. I mean, as we go along in this conversation, I think you'll get a much fairer idea about different kinds of assets and their liquidity. For example, a house, you cannot obviously sell a house if you need the money tomorrow, right? It takes some time to sell a house. So while you have the money, it is not liquid, it is stuck somewhere. It takes much more time to have it in your hand for the need that has arisen in the near future. So that is the essence of liquidity.
So, why would you say liquidity is so important, Kiran?
Let us go back a bit in time. Recently, we've seen the difficulties people faced during the COVID situation, early part when there was a lot of confusion. We did not know what is happening in the country. We did not know when the lockdown will get over. People were getting laid off. They were losing jobs. There were salary cuts. In such situations, how do you manage your household? The expenses are not going to go away. There are going to be expenses on your food, on groceries, school fee for your children, clothing, medical requirements. I mean, there are so many things that you need money for. And if your income source is impacted due to some reason, or if you're not in a position to earn your money, if the money flow stops, how are you going to manage? So that is when liquidity becomes essential. While you could have several investments that you're holding for a long period of time in different forms, how soon will you be able to convert it into cash? Because if you want to buy grocery, you cannot obviously sell gold and buy grocery, right? So that is the main criteria. So you should be able to have cash in hand as soon as possible, and especially in situations like what we have seen in COVID in the recent past, or there could be other situations. For example, if the main income earner in the family meets with an accident, and there is a loss of pay leave that is taken from office. So where does the income come from? I mean, if the salary is not coming in, how do you manage? So in such situations, liquidity becomes very, very important.
So, is there such a thing as too much liquidity, Kiran?
Uh, well, yes. So see, if you need X amount of money, you need to uh, have that money at as in when you want. But if you have too much liquidity in hand, say for example, you are keeping several lakhs in your savings account, that money which is lying in the savings account is not earning anything. It is not growing. What it is earning is a minuscule amount. 3 to 3.5% is the rate of return that you get in your savings account. Vis-a-vis, even if you make a small, short-term fixed deposit, which will give you 5 to 5.5%, that's 2.5% more, right? So there is an opportunity cost to having too much liquidity. If you leave too much money in your savings bank account or in other very liquid assets, you might lose an opportunity to earn a better return on it. Now, what does a better return give you? A better return gives you a wealth creation in the long run. So, if you leave too much money, you will have a negative impact on your wealth creation capacity. So, you might end up with having lesser corpus for your future than what you could have had if you kind of optimize the amount of liquidity that you have. So, instead of say keeping 10 lakhs in your savings account, would 1 lakh do? So each family actually will have a different, reply to this question. How much money do you want in your savings account, or how much liquidity should you maintain? It depends on several factors like what are your income sources? How can that income be impacted? What is the security of your income? As in, are you in a job, in a government job? So there is less likelihood that there'll be a job loss and liquidity will be impacted. Other situations like how many dependents are there in the family. So if it's a larger family and there are one or two income earners, so the impact on loss of income could be much higher. So that way liquidity could be impacted. The cash flows will be impacted if there is any issue regarding job or health, which prevents the income earner from actually going out and earning that income. So there are various customizations which are actually required to figure out how much liquidity should be maintained for each family or each individual.
A lot of us talk at home, Kiran, about creating an emergency fund for these needs that you mentioned, like accidents, etc., or any health emergency. So, can we say that liquidity is same as an emergency fund?
Well, that's a very interesting question, Yamini. So let us try and understand, what are the different levels of liquidity that are available. So, say if you have something like some amount lying in cash at home, or you have some funds lying in your savings account, you have bank fixed deposits, you have liquid mutual funds, you have other mutual fund investments, you have, say, postal savings, or you have a PPF account, you have some amount of gold coins or gold mutual funds, and you have some real estate. Now, each of these has a different level of liquidity. As in, if you go back to our original, question, what is liquidity? So, how soon can these be converted into actual cash, which can be utilized? Now, let us look at what is an emergency fund. So, emergency fund typically is something that you can access immediately for any unforeseen circumstances that arise in your life. So while emergency fund is a subset of liquidity, liquidity is a much broader term. So emergency fund can be, say, something like a 6-month expenses kind of corpus that you keep in either your savings account, fixed deposits, or liquid mutual fund. Whereas liquidity in a larger balance, if you see, is something that you need to view from a future perspective. Let me give you an example to explain this better. Say, for example, you are collecting some funds to send your kid abroad after graduation. You have made several investments towards that particular goal. Now, how soon will you liquidate those investments? As in, how soon will you get out of these investments? Say, for example, you have kept a house and you said that I will sell this house when I have to send my kid abroad for further education. You will not wait till 1 year before the kid is going out, right? You will start the process of selling the house much earlier because you know it takes a longer time. Again, if you have something else, say for example, you have equity mutual funds in which you have been investing for the same goal to send your child abroad, will you wait till 6 months, or will you wait till 1 week when the fee have to be paid? You can actually, technically you can, but there is a risk attached to that. What if the stock markets fall? Because equity mutual funds are linked to stock markets. So if you have attained, say, 50 lakh rupees in that fund, and the stock market falls, the value of your 50 lakh will go down to, say, 45 lakhs. So you might end up falling short of the money. So in that scenario, what you actually do is you sell the money from the equity funds maybe 2 or 3 years before you are actually sending your kid abroad, so that the stock market variance will not impact. So in that scenario, your fund should be saleable. You should be able to sell that fund and generate liquid cash out of it, as in the money should come to your savings account. Now, there could be scenarios, which prevent certain assets, that is, certain investments, which you cannot withdraw. Say, for example, PPF. It's a government scheme, but it is a locked-in scheme. So you cannot say that I want the entire money in my PPF and it should come to my account tomorrow. That is not going to happen. There are rules and regulations under which you can withdraw certain portion of your PPF, not the entire money. Similarly, for example, a bank fixed deposit. A bank fixed deposit, while you can break it at any point of time, there will be some penalties which will be levied. Say, if you've kept a fixed deposit for 5 years and you're withdrawing it at the end of 2 years, the bank will levy some penalty for the early withdrawal. That way the liquidity reduces. So the ease with which you are actually converting it into usable cash is being reduced with each instrument. And each investment or each investment instrument has different rules and regulations and different characteristics, because of which you say the liquidity is different. So if you get the gist of this answer, emergency fund is a subset of liquidity, whereas liquidity is a much wider term which you need to understand before putting your money in for certain life goals.
Well, Kiran, that actually simplifies it to, a lot for those of us who are, just learning the ABC of financial planning and liquidity. So the next question would be, where does one start with building emergency funds?
Okay, so let us look at what kind of emergencies any person can face. So one, as we were discussing, it could be a job loss situation, or it could be a salary cut, like what happened in COVID. So I've heard of, people get having a salary cut of as high as 80%. So how do you manage to run your household with that 20% amount that you're getting? Or if there is a illness which lasts for very long, and there is loss of pay, or there is a loss of job because of that, then how do you manage? What if the primary income earner in the family dies? How does the family get the income? So these are various situations in which emergency fund can be used. Now, these were all negative situations. Let us look at some positive situations which can arise. Say, for example, somebody who's in a job is going for entrepreneurship. So there will be a period where there might be no income, because if you're starting a new business, so initial years are a little difficult. There could be issues where you are not getting cash flow to maintain your expenses. So for those 2 3 years, you will have to keep some money aside so that the family expenses are not impacted. See, because whatever the situation, I mean, whether you're earning your income or not, your expenses are not going to stop. So you need to provide for those expenses. Now, how do you actually decide on how much, and how do you build it? So how much is a fact of what is your situation, what kind of job you are in, how many dependents do you have, what life situations are they in. Say, for example, somebody with kids who are grown up and already finished this studies. So in that situation, the dependency of kids is not there. But somebody with a young family and dependent parents, the requirement for an emergency fund could be larger. Now, somebody who's in a government job, or a job which, it's the redundancy in that job is very low. In those situations, the requirement for emergency fund is much lower. Vis-a-vis somebody who's in industries which, the layoffs are pretty high. So, for example, IT sector, or maybe BPO, or such industries where the jobs can go off pretty soon. So, in such scenarios, you will need to maintain a higher amount in your emergency fund. So it depends on what kind of situation, life situation you are in, to figure out how much emergency fund do you need. Now, where do you keep this money? That could be the second question. How do you keep emergency fund? So probably you can have a three-tier structure. So primarily, obviously, there is some cash which needs to be kept at home, because that is something that you can immediately use. Second level is the savings account which you maintain in your bank. Third, I would say I would prefer a liquid mutual fund because of ease of access. Now everything is online, digital. So you can get money from a liquid mutual fund at a 1 day notice, one working day, and the money is in your account. Bank fixed deposit is a very well understood, product. So you go to a bank, you make a fixed deposit, and you break it whenever you want. But of course, as I said, there would be penalties for premature withdrawal and things like that. So, depending on your comfort level, you can choose between bank fixed deposit or liquid mutual fund. So, those are some of the primary ways in which you can maintain your emergency.
Those are really helpful. That's a really helpful starting point for women, Kiran. The next step would obviously to help ensure that the fund keeps building. So, are there any tips that you would like to share with our women viewers on how they can ensure that their liquidity fund keeps building?
Yeah, so see, again, I will divide it into two parts. So, one is the emergency fund, which we just spoke about. So, just ensure that uh, the money in the emergency fund that you've decided that I need X amount, say I need 3 lakhs in my emergency fund at any point in time. So, if at any point in time you dip into that fund for utilization in any kind of situation, ensure that you replenish that fund so that you don't forget about it, and next emergency, then you don't fall short of fund in that. As far as the other broader aspect of liquidity goes, whenever you are investing in any financial instrument, just figure out how it kind of pools into your life goals. Like we spoke about sending kids abroad for higher education. So how many years are left to that uh, event? Based on that, you select your financial instruments, and based on that, you do the investments. Now, again, the same example I will take again, the real estate part. So if you're thinking of selling a house, say for kids' education or for your own retirement, understand that it is not a very liquid asset. So you might end up being stuck with a property which you had thought of using for a particular life goal. So there should always be a plan B. So don't use very illiquid instruments and don't depend totally on one instrument to service your particular goals. Have some options, have some kind of combinations. On a broader level, you can have some money in various kinds of assets so that if there is a problem in one, you can draw from the other and utilize the funds. So that is how the overall portfolio is built. It cannot be too much in one particular kind of financial instrument or one asset class, if I may say. You can't have everything linked to stock market. You can't have everything in a liquid mutual fund or everything in real estate. So that will cause its own problem when you need to withdraw the funds or when you need to accumulate wealth for your future goals.
Wow, that was really insightful. So now let's open the floor for some questions and see if our viewers have anything that they would like to ask you. We will see the ticker show when there are questions about liquidity. So the first question is from Ridhima, who wants to know how much liquid savings should a fresher, someone with an entry-level job, have? What percent of their salary to be specific?
Ridhima, as I said, it is not a cookie cutter answer. It is very difficult to say. Now, for example, a fresher with dependent parents will have different requirements than a fresher whose parents are financially independent because they can manage on their own, right? So there is no cookie cutter answer for it. You try and figure out uh, what will happen if your income stops. What are the expenses that you will still need to maintain, and how soon can you get another job? So that is the primary way in which you can answer in your own life. What are the situations that you foresee can create problems? So to cover up for that time period, you need to keep that amount of money aside in as an emergency fund. That could be the simplest way to provide an answer to yourself for your requirement.
And the next question is going to be from Ritika, who wants to know, do you have any tips for maintaining a balance between liquidity and investing? That's an interesting one.
Oh, that's an interesting one. Yeah. So, Ritika, what I would say is, see, investing. It's a very broad question, actually. So, let me break it up in this manner that you need to look at saving at least 20% of your income towards your long-term goals. Otherwise, it will be very difficult to beat inflation and pay for yourself in the future for different kind of goals that might come up in your life at a later stage. So this is a thumb rule again. I mean, at least 20%, go as high as you can. So as a youngster, somebody who is not got any dependents, they can go as high as 50 to 70% of their income as savings. And savings, as in savings that are being invested wisely. So not everything kept in the savings bank account, right? So that is one. Liquidity, again, as I said, on a broader scale, group one, your emergency fund. Group two, based on your goals, you should be able to withdraw that money at that point in time. So if you're, say, planning for a vacation abroad in, say, 3 years' time, and you need certain amount for that, So you wouldn't want to put that money into, say, an equity fund, which could be very volatile in the short term. While there is a possibility that you might make a good return on it, there is also a possibility that you might go negative. So you will not select equity fund for a 3-year goal. And a 3-year goal, again, like a vacation, is not something mandatory, vis-a-vis, say, the kid going to college. You cannot ask the kid, okay, mera paisa nahi bana hai, I will send you to college next year. So that is a goal which cannot be postponed. The timelines cannot be changed. Whereas a vacation, or say buying a home, that is a goal which can, the timelines can move a little bit if the money is not available at that point in time. So have a good balance between what your goals are, whether they are very strict timeline goals, or they are goals with timelines that can be deferred a bit if the money is not available. And look at instruments which are more liquid for the goals which have strict timelines. And you can go in for a locked in product for things which are you can fluctuate a little bit in the times for those kind of products.
I hope you have your answer there, Ritika. So Deepshika wants to know what percentage of our salary we should always have as emergency fund.
Deepshika, see, it's not a percentage of salary that you create an emergency fund. Emergency fund is an absolute number that you're looking at. As a thumb rule, I would say it is 6 months worth of your expenses. Now, 6 months of worth of what expenses? One is whatever is required for your regular expenses at home, say food, grocery, electricity, telephone bills. Apart from that, if you have children, their school fees obviously cannot be deferred, so you need to keep that money also included. If you have any loans, you cannot not pay the EMI, because that will impact your credit score. So your EMIs need to be built in. So if there is a gap in income, your EMI should not bounce. Then you can keep your term plan, your insurance premiums also in that, especially your health insurance and your term plan. So this is the combination of expenses that you need to club, and you will arrive at an absolute number that you need to keep as an emergency fund. Also, I will add here that when you talk about salary, the percentage of salary, you can gradually build up the emergency fund. Obviously, when you're starting in your career, you will not have that kind of assets or that kind of income to put a lump sum there as an emergency fund. But you can maybe start a small monthly SIP in a mutual fund, or a recurring deposit in a bank to build up this emergency fund on a gradual basis. So arrive at that number divided by, say, 12 months, and that is the amount that you need to put into from your salary.
Absolutely, that makes a lot of sense. Let's have the next question. So Stuti wants to know what is the best form of liquidity when it comes to the first-hand emergency fund.
Oh, wonderful. Best form is cash. So obviously, if you have cash at home, or if you have something in your savings account, that is immediately usable, so that is something that you can use. But as you understand that cash does not earn anything, so it is a zero return kind of thing, and you might not need a large amount in cash, because emergencies don't come every day, and we hope that they never come, but they do happen to people, right? So cash, while it is the best form, it is not very practical to keep everything in cash. So you can then look at the other options that I had mentioned earlier, as in keep some amount in the savings account, keep some amount in the liquid fund. So that will earn you some amount of return, which is better than holding cash. Because if you're not using the money for 2, 3, 5 years, it better grow. It should not stay stagnant.
Well, Trisha wants to know, I run a home-based business which generates regular income. Why is liquidity still important for me? I think a lot of
Uh,
entrepreneurs would be
Yeah, right, sure.
wondering about that.
So, yeah, Trisha, see what happens is, again, I will go back to the most recent example of COVID. So, a lot of home-based businesses had to shut down forcibly. So in that period of time, then how do you manage? I mean, if that is the income that you're depending on, how do you live through that difficult period? So even though you have a business which generates income, liquidity is still important. And I would say not only for home-based businesses, it's also, you need to have two levels of liquidity if you're a business person. If you're running your own business, You need to have some liquidity for your business and some liquidity in your personal finance also. And you better not mix the two, because what will happen is if there are simultaneous emergencies in both places, if the business is also stuck and your personal income is also impacted, uh, you will find it very difficult to go through that period. You might end up being in debt. You might have to take a loan to kind of survive the important expenses. So in that way, keep a separate for people who are running larger businesses, keep a separate business emergency fund and keep a separate personal emergency fund. That should not be mixed at any point in time.
That's, I think, a very important advice to keep your funds separated. Ridhima wants to know, my parents and other elders in the family buy gold as the ultimate solution for emergencies. And in today's times, is it still a good investment?
Uh, well, gold is actually, more culturally accepted as the last saving grace for any family. But come to think of it, how many of us actually end up selling gold in any situation? It just passes on from locker to locker. It is
Yeah.
not even worn these days. It's just passing on from generation to generation. It's just sitting there in the lockers. It's only the wedding day that the bride wears gold. Apart from that, I don't think, the newer generation even likes to wear gold. So, as an investment, yes, gold can find a place in your portfolio. Maybe 5 to 10% of the total amount that you're investing in your portfolio can go towards gold. But as an emergency fund, there are questions that arise. What happens is when you actually go to sell gold, one, if it is in an ornament form, there will be a lot of losses because they will cut the making charges and there will be some incidental losses also. So you might end up with much lesser value than what you actually, think it is. Secondly, there was a survey done by one of the media houses recently during COVID. People were not able to get cash for gold. So if they went out to sell gold, the jewelers were willing to give you jewelry in exchange, but they were not willing to give you gold. And COVID, I think, was the most extreme example where people actually had to go out and look for options to sell gold. But if uh, in such extreme situations, if you're not able to raise cash, it is of no use. So instead of then having physical gold, maybe having gold in electronic form makes more sense. Say in the form of an ETF or in form of a gold mutual fund, which you can sell electronically in the market, and you can raise money out of that. So yes, to a certain extent, it makes sense, but in what form is something that you need to ask yourself.
That is, I think that should clear any doubts that she has about buying gold or not, and how much, maybe. So Tanisha wants to know, I have investments in mutual funds. Do I need to look out separately for liquidity? I think that's a question a lot of us have.
Right. So, see, mutual funds is a very broad investment category. So, mutual funds are of different kinds. So, there could be mutual funds which are linked to the stock markets, which most people are aware of. So, they are the equity mutual funds. There are funds which are known as debt mutual funds, which again is a separate category and it is not linked to stock markets. Uh, you have gold mutual funds as well. Now, silver funds have also come in. You have hybrids, which have a combination of all these four. So, depending on what kind of mutual fund you have, the time frame for realizing the funds, as in, say, for example, if you are holding a equity mutual fund, and if you do a digital transaction, the money comes to your account on day four, that is T+3. Whereas if you are holding a liquid mutual fund, you get the money the next day. So you put in a transaction today, and the next working day you will get your money in your account. So there is a time variation in getting the money into your account depending on what kind of mutual fund you're holding. Again, as we had earlier discussed, equity mutual funds have their own risks in terms of volatility. So if you want to withdraw at certain point in time, and say something like March 2020 happens when the market crashed, the day the lockdown was announced, and you need money at that time, you're depending on your equity fund, you will have to withdraw at a loss. So that cannot be considered, for say something like an emergency fund. Yes, of course, it is liquid. You will still get the money, even if the value is down. You will be able to get it in the defined timelines because it is a very regulated product. So definitely, it is liquid, But what kind of liquidity you are looking at, depending on that, you will have to select the appropriate funds.
That's great. I think, oh, we have one other question from Renu. So, how does one decide how much cash to keep? Is there something as too much cash?
Well, see, one, it depends upon the comfort level. So, I was speaking to a client. She said earlier I used to be very happy even if I had 500 rupees in my pocket. Now, even 5,000 rupees seems like a little less. So, depending on your lifestyle, depending on the kind of expenses you have, and the kind of fears that you hold, your level of cash holding will differ. Each person will have a different view to it. So not too much, not too little. Again, there is a safety aspect also. You can't hold so much cash at home or in your wallet. So depending on your comfort level, you should be able to decide on an amount that you are comfortable.
Well, Swati wants to know planning financial instruments at right time is important. Very informative session. Oh, thank you, Swati. Thank you. We are glad that you like this session. And I think I would like to thank you as well. Oh, Vanshika also wants to have a question. I think we can take one more, Kiran. Do you recommend getting a student loan or selling some old shares?
Okay, I'm guessing that you're looking for providing for education, higher education. That's where you're, baffled between taking a loan or selling some old shares. So see, both are good options. Now depends on what is the value of your shares. Will that suffice to sustain your education? Uh, or if you sell those shares, what is your liquidity position? Again, if we come back to liquidity, if you sell that, is that the only thing that you have in terms of investment? Are there other things that might come up in future where you will need the money? So if you're getting, pulling all the money out and putting it for just one goal, what happens to the other things that will come up in the future? That is one part of it. Second, if you're looking at a student loan, do understand that you will have to start repaying as soon as you start earning. So that is usually the rule is that within 6 months of passing out of the course or getting a job, whichever is earlier, you'll have to start repaying the EMI. So whatever stream of education you're pursuing, will you get a job which will be in line with the EMIs that you will need to pay. So you should get a job which is obviously paying you higher than that. So look at the stream of education that you're going in for. Some streams, unfortunately, even if you pay a huge amount of money as a fee, it does not actually end up you getting a good job. So think of that and then decide. Both are good options depending on your particular situation.
I hope you have your answer, Vanshika. So I guess we are done with the questions. Thank you, Kiran, for this very informative session with us. I hope our viewers have all the answers that they needed to know about what liquidity is, how it works, how you can build it, what you need to keep in mind. So thank you for this session, Kiran, and
A
thank you
pleasure,
to our
Yamini.
viewers for joining us today. Please stay tuned into this new series by She the People in association with BSE Investors Protection Fund called Invest Her. We will be back with more such interesting conversations just for you. Thank you.
Thank you.